Welcome to our presentation on NRAS. In this video we would like to share with you what we believe to be a unique opportunity which is an essential consideration for any property investment portfolio. Firstly, NRAS stands for the National Rental Affordability Scheme. The outcome of this government initiative, which was commenced in 2008, is to increase the supply of affordable rental properties and aimed at a specific tenant profile. I must stress at this point, it's not social housing. It's a commercial incentive program to encourage property investors, possibly like you, to invest in quality real estate in specific areas. When first introducing this opportunity to clients, I always make the point that you can't tell which property is an NRAS property, as they are situated in quality residential neighbourhoods, unlike Housing Commission homes. NRAS licences are only granted in limited numbers and are only on new properties. They also need to be situated in communities that offer amenities that people require, such as public transport, shopping centres, schooling and kindergartens, areas with infrastructure and employment hubs. When the government created this program, they had specific key workers such as nurses, policemen, firemen and teachers and paramedics, etc., or other eligible tenants of your choice who qualify according to incomes, as you can see in this presentation. Why an NRAS property is attractive to these potential tenants is that they'll be renting these properties at 20% below the market value. So as an example, if the market rental on a property was $400 per week, then they would be getting it for $320. Because of this, tenants will be good long-term renters, as they would have to have a good reason to leave when you have an incentive like this. So what does the government offer investors through the NRAS program? This is where it gets really interesting. By providing this 20% discount, you will receive this year a tax-free incentive of $9,981, which at a tax rate of 31.5%, this equates to a pre-tax payment of $14,570. This incentive is indexed each year by CPI. However, since 2008, it has averaged over 4% per year, which is higher than inflation. Now there will be some astute investors watching this that will have figured out that by reducing the rent by 20% increases the gearing, and as a result provides a greater tax deduction. This I will explain further a little later. Now let's look at the numbers. Let's take a realistic example of the first year. In this case, the property purchase was $354,250, and we have borrowed the complete purchase price by securing it against another property. The market rental is $340 per week. So as you can see, there's two columns. The first column is the investor column, the second is the NRAS column. So it's exactly the same property. So in this case here, under the investor column, the rent that they have received is $17,680. Whereas on the NRAS side, it's $14,144, which is the 20% discount. In both cases, it's exactly the same one, and at a 6.25% interest rate, you are paying $22,141 in interest. Now, on the investor side, you'll see the real estate management fee is $1,945, which is greater than the NRAS. The reason why is the NRAS is calculated at the lesser rental rate. In both cases, the depreciation is $10,000 per annum. And the compulsory costs, which are things such as rates and insurances, on the investor side is $2,285, whereas under NRAS it's higher because there is a cost of running the license. In this case here, the total tax deduction on the investor side is $18,691. On NRAS, it's $22,938. So as you can see, the tax deduction back to the traditional investor is $5,888, whereas the NRAS investor receives $7,225. With the investor, they receive no incentive, and for the NRAS investor, they are getting a $9,981 tax-free incentive. So the difference in cash flow is the investor gets a positive cash flow of $2,803, whereas the NRAS investor has a positive cash flow of $4,268, which means you're in a better position of $7,071. What does this mean over a 10-year period? As you can see by this slide, The net cash flow over the 10 years starting in 2013 with a CPI increase of 4% per year represents at the end of 10 years a total cash tax-free amount of $86,889. That's just the cash flow. Let's look at the summary of this example. As you will see in another part of this website, that if we project forward just at a 6% capital growth, which is well under the average going back to 1965 in Melbourne, this example property will have grown from $354,000 to $618,000 over the 10-year period. Now that represents a capital gain of $273,000. Remember, in this example we borrowed 100% of the funds to purchase the property and have had an after-tax cash flow of $87,000. So the combined return over the 10 years is $359,900. So in conclusion, you can see now why we ask our clients to consider this opportunity, and as we say to them, NRAS puts your internal rate of return on steroids. If you would like to learn more about this and or our other strategies, please contact us today for a no-cost, no-obligation property wealth discovery. Thank you for watching.